March 2020. I'm staring at my laptop screen and my portfolio is down 35% in 3 weeks. My finger is literally hovering over the sell button and I'm thinking, everyone else is getting out. The news say it's going to get worse. Am I the idiot here for holding on? Then I remembered something I read in J.L. Collins' book, The Simple Path to Wealth. Most people lose money in the stock market, not because the stock market goes down. It actually goes up relentlessly over time. They lose money because of psychology, because they panic at exactly the wrong moments. Understanding these 3 psychology traps saved me from making a $50,000 mistake that day. So let's talk about the traps that cost most investors real money and how to avoid them. The first trap, the one that almost made me hit the sell button in March 2020, is the panic greed cycle. Here's the uncomfortable truth. We are psychologically hardwired to do exactly the wrong thing with our money. We're programmed to buy high and sell low. It's not stupidity, it's biology. Let me give you my own example. March 2020, the market crashes 35% in a few weeks. My brain is screaming at me, sell everything, save what you have, this is going to get worse. December 2020, the market's at all-time highs. We covered everything and then some. Now my brain is saying, this is amazing, put more money in, don't miss out. You see the problem? When prices are low and things are on sale, I want to sell. When prices are high and expensive, I want to buy more. Exactly backwards. And here's the crazy part. There's actual data on this. Morningstar did research showing that most mutual fund investors get worse returns than the mutual funds themselves. Think about that. You buy a fund that returns 8% per year, but you personally only make 5%. How is that even possible? Because we try to time the market, buying high when we feel good, selling low when we panic. Warren Buffett said it perfectly, and I'm paraphrasing here. The Dow started the 1900s at 66 and ended at 11,400. How could anyone lose money during that period? People lost money because they kept trying to dance in and out. So what's the fix? Automation. Set it and forget it. I have money automatically going into my index funds every week. Same amount every time. Market up, money goes in. Market crashing, money goes in. I don't think about it. I don't decide. It just happens. Now, full disclosure, I still check my portfolio when the market drops. I'm not perfect. Old habits die hard, but I don't act on it anymore. I look, I feel that little spike of panic, and then I close the tab and go make coffee. That's progress. But here's the thing, the panic greed cycle is just the first trap. The second one actually feels smart when you're doing it. 2018, I spotted what I thought was a trend in tech and telecom stocks. I picked 5 companies, put some money in, and 4 months later, I'm up 19%. The broader market during that time, down 7% for the year. And I'm still thinking, I'm actually good at this. The market's down, I'm up, maybe I found my edge. Maybe I'm one of those people who can do this. That 19% while the market's dropping, that's incredible. It's also completely unsustainable. It was luck. Pure dumb luck that happened to land in my favor. Here's what matters. Over 80% of professional investors, people who do this for a living with research teams and Bloomberg terminals and decades of experience, they can't beat the index over time. And I thought my 4-month hot streak meant something. Over my first few years of investing, I've tried stock picking on and off. The wins completely wiped out by the losses. I finally gave it up 7 years ago when I committed to pure index fund investing. If I just started with index funds from day one, I'd have more money today. And here's the thing that really drives this home. Warren Buffett, Peter Lynch, Michael Price, you know the names, right? You know why you know the names? Because successfully beating the market over time is so incredibly rare that the handful of people who've done it become household names. They're famous because it's so hard to do. My stock picking track record looks like a heart rate monitor during a horror movie. Just wild swings everywhere, averaging out to worse than if I had done nothing. But stock picking at least feels exciting. There's one trap that actually feels responsible and smart, and it might be the most expensive one of all. 2015, I'm sitting at my kitchen table with a Morningstar report printed out in front of me. I'm highlighting top-rated mutual funds, reading about star managers, looking at past performance charts. I'm thinking, okay, picking individual stocks seems risky. Too much can go wrong, but surely these professionals can do it. They have teams, resources, expertise. I'll just let them do it. This feels smart, right? This feels responsible. Hire an expert. Here's the math that destroys this entire idea. Only 20% of actively managed funds beat the index over time. 1 in 5. 80% fail. But here's the kicker. 100% of them charge you high fees to try. And you might think, okay, I'll just find that 20%. I'll pick the winners. You can't. There's no way to predict which managers will be in that 20%. Past performance doesn't tell you. In fact, every fund prospectus literally says this: past results are not a guarantee of future performance. It's right there in the legal document. Nobody reads it. Everybody ignores it. Want to know how the mutual fund industry really works? When a fund underperforms, and most do, the company just quietly closes it. They fold those assets into a better performing fund. The bad track record disappears. The company can keep saying, look at our winning funds, because the losing ones got erased from existence. Want proof this is about profits, not performance? There are actually more mutual funds than stocks out there, because it's more profitable to sell funds than to actually pick good stocks. This isn't about helping investors. This is a profit machine for fund companies. And I fell for it. I'm paying someone 1% a year to manage my money. The index fund I could have bought cost me 0.04%. That seems like a small difference, right? What's 1%? Let me show you what 1% actually costs. Say you invest $500,000 over 30 years. That 1% fee difference costs you over $200,000 in lost growth. Not $200,000 in fees paid, $200,000 you would have had if that fee wasn't dragging down your returns every single year. I'm literally paying someone 6 figures over my lifetime to probably do worse than a fund that costs almost nothing and requires 0 decisions for me. These 3 traps, panic greed cycles, stock picking, chasing expert managers, they all have something in common. They're all focused on the wrong thing entirely. J.L. Collins has this brilliant analogy about beer and foam that completely changed how I see the stock market. Imagine you're pouring a beer. If you pour it carefully down the sides of the glass, you get mostly beer with a nice little foam head on top. If you pour it fast, straight down in the center, you get a glass full of foam with a little beer at the bottom. The stock market is both of those things at the same time. There's the beer, the actual business, companies making products, providing services, generating profits, growing over time. This is real. This is solid. This is what actually drives wealth creation over decades. Then there's the foam, the daily price fluctuations, the CNBC shouting matches, the expert predictions, the market's going to crash or market's going to the moon headlines. This is noise. This is drama. This is people freaking out or getting euphoric about things that don't matter. Here's the problem. When you look at the stock prices on any given day, you have no idea how much is beer and how much is foam. A company can drop 20% in value in one day because some analyst downgraded it, then bounce back next week when earnings come out strong. Did the underlying business change? Not really. But the foam was going crazy. And the media knows this. Nobody's going to watch CNBC if some rational person comes out and says, invest in the index funds for the long term and ignore short-term volatility. That's terrible television. They need drama. They need urgency. They need one expert saying the market's going to 20,000 by year end and another expert saying we're on the verge of collapse. Every single talking head on that channel is impressively credentialed. They've got MBAs from Harvard, decades of experience, managing billions of dollars, and they all completely contradict each other. Why? Because they're all guessing how much beer versus foam is in the glass right now. It's unknowable. It's irrelevant. What actually matters is the beer, the business underneath all that froth and noise. And over time, 10 years, 20 years, 30 years, the beer is what wins. The businesses grow, the economy grows, and your wealth grows with it. Once you understand the beer versus foam distinction, everything changes. You can watch CNBC and see it for what it is. Entertainment, not insight. You can check your portfolio and recognize the foam without reacting to it. You stop caring what some expert thinks is going to happen next quarter because you know what matters is the beer. Here's the simple truth that took me way too long to accept. Index funds let you own the beer and completely ignore the foam. You don't need to time the market. You don't need to pick stocks. You don't need to find the magical 20% of fund managers who might beat the index. You don't need to watch the daily drama. You buy a low-cost index fund, something like VTSAX or VTI, that owns basically every publicly traded company in America, and you just hold it. That's it. That's the whole strategy. I've been doing this for 7 years now, straight index fund investing. I've lived through the 2020 crash, market dropped 35% in 3 weeks. I kept investing. It recovered. I kept investing. Over those 7 years, I'm up over 82%. Not because I'm smart, not because I timed everything perfectly, because I owned the beer and ignored the phone. The only skill this requires is doing nothing when everyone else is panicking. That's it. The hardest $50,000 I ever made was the money I didn't lose by not selling in March 2020. I didn't do anything. I just didn't panic. And that saved me tens of thousands of dollars. It's not exciting. There are no war stories about the stock you picked that went up 500%, but my portfolio doesn't need to entertain me. It needs to grow. So you've avoided the 3 psychological traps. You're investing in index funds. You're ignoring the foam and owning the beer. You're building wealth while everyone else is panicking and chasing performance. This is the foundation. But here's what nobody talks about. The one type of market crash that hits differently. Not because index funds stop working, but because of when it happens in your timeline. I'm talking about what J.L. Collins calls the big ugly event. Think the Great Depression or Japan's lost decade. The 1929 crash took 26 years to fully recover. If you were 60 years old and planning to retire, that's devastating. If you were 30 and kept investing, that's the buying opportunity of a lifetime. Same crash, same index fund strategy, completely different outcomes based on one factor, your timeline. That's the next video. How to bulletproof your index fund strategy for the big ugly event no matter when it hits. Click it now, because if you're within 10 years of retirement, this changes everything.